Hello, my name is Reit, and this is a quick video to discuss what a Reit is. Most people in our industry are familiar with the major hospitality brands and management companies like Marriott International, our company, and some of our competitive brands, our competitor brands. But if you're new to the industry, you may not be familiar with some of our ownership properties or familiar with the model that most management hotel companies do not own a majority of the assets that they operate in or manage, but have partners that own the hotels. So some of these hotel ownership companies like Host Hotels and Resorts, or some of these other partners listed on this screen, primarily own real estate and are organized as what's called a REIT, or a real estate investment trust. Now, a REIT is simply a company that owns and manages income-producing real estate, and most REITs specialize by property type. They invest in major property like office buildings or apartments, shopping centers, regional malls. There's even some REITs that specialize in owning private prisons. For our discussion, we're obviously focusing on the types of REITs that specialize in hospitality, either hotels, restaurants, golf courses, and that sort of thing. Why do REITs exist? Well, historically, it's very challenging for some people to buy land, and previously, it was impossible for small investors or people who didn't have big money or institutions backing them to purchase land because of the cost and liquidity of buying and selling big hospitals or hotels or big land purchases. So in 1960, Congress enacted a law that was later signed by Dwight D. Eisenhower called the Cigar Excise Tax Extension, which contained an amendment creating the opportunity for companies to organize as real estate investment trusts. What this allows to do is evening the scale so that people with relatively small amounts of money could still undergo the large purchase of land or participate in income generating land purchases or land investments or property purchases or property investments without necessarily having to incur the problems that go with buying land. In essence, they could buy some of these companies that I just listed previously in the brand page that had shares available for much smaller purchase amounts, and also shares that offered much higher dividend yields. As you can see here, the dividend yield for each of these companies is significant, is in a 3 to 5% range, which is approximately double the dividend yield for some of the management companies that I showed you before, like Marriott, Hyatt, or Hilton. Now, because it was organized by Congress, there's a lot of rules around what you have to do to organize as a REIT. In fact, there's only probably 130 to 150 REITs in the country right now, with a market cap of about $500 to $600 billion. The first rule for REITs is they have to distribute at least 90% of their taxable income to shareholders as dividends. This means that they can deduct that from shareholders, which produces one of the biggest benefits of a REIT is they don't have to pay corporate taxes on their income because they're divesting it to all of their investors. Other regulations of REITs include that they have to have 75% of their assets must be in real estate, cash, or government securities. At least 75% of their gross income must come from rents or things related to the ownership of real estate investments. And they have to have a big number of shareholders, a minimum number of 100 shareholders for each company, whether it's a private or publicly held REIT. Some of the benefits to REIT that I just discussed are the high yields and the simple tax treatment. They can avoid the payment of corporate taxes because they're divesting to their ownership. It's also very straightforward in the tax process. The REIT can send a 1099 to shareholders and break down the dividend distribution, so it's straightforward. It's also very liquid. Again, you don't have to go through the transaction process or getting a real estate agent or the difficulty sometimes that's incorporated in selling land. You can buy and share on the open market just like other stocks. And it offers great diversification that finally people can now, or I guess since 1960, invest in this way to participate in the real estate market. Again, as I mentioned, there's high yields. This if you look at the Dow Jones Real Estate Index, it's outperformed the Standard & Poor's 500 by about 80%. And since 2009, the real estate index has delivered approximately a 300% return, which is mainly real estate investment trust. Some disadvantages of REITs are it's sensitive to demand for other high yield assets. There are tax implications on the negative side. For example, property taxes, they do have to pay property taxes if there are different investments, and those types of taxes can be changed. So if a hotel is in a county or a place that has the government's having difficulty funding things, they might raise property taxes to help fund government items, and so there could be negative implications from property taxes. And also there are tax implications from once the dividends are distributed to the investors, they do have to pay taxes on those rates. But all in all, as you can see from the success of many of these companies, it's a booming business, and there's been a lot of success in REITs. Hopefully this video has helped describe what a real estate investment trust is and helped you understand some of our key partners in the hospitality industry. Thank you.